Thanks for joining David, Kevin, and myself for the market update for the month of August. Hope you and your families are doing well. I know we are. We just enjoyed our family trip up to Orville. What's going on in August? Well, markets were slightly off in August. We had 5 months in a row of great returns, and they were slightly off now. David and Kevin are going to tell you what was moving the markets in August, as well as looking ahead and what you should expect. Take care. If you need anything, don't hesitate to call. Bye-bye.
David, what was moving markets in August?
Well, Kevin, it's not too uncommon to see markets retreat a bit in August due to seasonality. In fact, going back in the past 20 years, the S&P 500 has averaged a negative return of minus 0.1%. So not too negative, but the trend definitely, there's been a slightly more negative Augusts than not going back in the past 20 years. Part of that is just due to seasonality, so you get lower trading volumes throughout August, definitely the back half leading into Labor Day, as traders and investors, Wall Street folks are typically out of the office and not doing a ton of trading in August. We also had, around the globe, business activity in China has been waning in previous months, although August did show a bit of an uptick. But you've got quite a bit of unemployment in China. Manufacturing in China has definitely slowed in the past few months. So that is a bit of a concern for markets. And then also the main thing is obviously still the Federal Reserve in the United States and the Bank of Canada here at home in Canada. Have been keeping interest rates high. We've seen interest rate hikes for the better part of the past 16, 18 months now, and it seems that interest rates will be either left at these elevated rates for a little bit longer than maybe the market had anticipated just a little while ago, and so that was weighing on the markets as well in August for sure. Can you tell us about what we should expect looking ahead, Kevin?
Yeah, so inflation has been easing in the U.S., and last week all eyes were on the U.S. job report that came out on Friday, and as David just mentioned, they had a fairly hawkish sentiment because inflation hasn't come down as much as they would like. So Jerome Powell did indicate that the Fed is committed to keeping rates at elevated levels longer in their fight to bring inflation back to the target that they want to see. In Canada, economic activity slowed down, only growing by 0.2% in the quarter, and that was led by a slowdown in new construction as well as a slightly downward turn in consumer spending. Canada's GDP number came in below the Bank of Canada's estimates, suggesting that the higher interest rates that we've been dealing with for so long are starting to weigh on economic activity a little more than they originally thought. On Friday, StatsCan's data release also pointed to a cooling economy, showing that unemployment has ticked up slightly to 5.5%, and roughly 6,400 jobs were removed from the market. Also in Canada, inflation did rise a little bit in August, which has now got everybody focused on our rate announcement, which will be coming out tomorrow. And looking at the market, people are pretty divided on whether they think rates will be held the same or not.
Mm-hmm. Although we all love to see the markets go up month after month, seeing the market have a little bit of a retraction in August is not anything that we're overly concerned about at all. It's perfectly normal. And overall, 2023 in aggregate has been a pretty good year thus far. Most clients' portfolios have almost made up the losses that were incurred in 2022 when the rate hiking cycle began in earnest. But it's important to just keep things in perspective and recognize that a little bit of a retraction is normal and maybe even actually a good thing. And what we're starting to see too now is the impact of all these rate hikes are having on the economy. We are in Canada and the United States to a degree starting to see the desired effects taking place. So, unemployment is ticking up a little bit, which sounds bad, but unemployment going up is a necessary ingredient to get inflation to start to come back down towards that desired 2% target. And just remember that the central banks may be anchoring to that 2% target, or at least that's what they're going to tell us. But it may very well be that once inflation gets back down to 2.5% or 2.7%, they may be satisfied with that. And that's what the market's trying to decide, is what line in the sand they'll be happy with and how high interest rates still have to go from here. But it's clear that the interest rate hikes, in mortgage rates in the United States are at 7%, mortgage rates in Canada here are at 6%. These rates are beginning to have a real effect on the economy. And what we need to see now over the next 6 to 12 months is how that will play out. Are we actually going to get that hard landing sort of recession, or are we going to be able to skirt that? And while unemployment goes up a little bit, most people will still be employed. Most people will still be able to make their mortgage payments. That is the desired outcome. And right now it seems like that should be what occurs.
If you do have any questions, feel free to reach out to Harry, David, or myself at any time. Thank you.